Please, can you bring that thing back? Hello, good evening. Kindly confirm you can hear me clearly.
We can hear you.
All right, thank you. All right, tonight, let us review interest rates risk management. Please, Ruth, what are you doing in this class, Ruth? Are you in this class?
Yes, sir.
Oh, FM class, or SFM class?
SFM.
Oh, really? I don't know, sorry. I thought it was a lady in the FM class. Please, let's check our speaker and mute. Now let's discuss interest rate risk management. At the start of this topic, risk management, we explained that risk management, we have two subtopics. The first topic is, of course, when you say risk management, managing financial risk. Managing the financial risk of the business. We are looking at that aspect of financial risk. Under it, we discuss foreign currency risk management. That was the first subtopic. The second aspect of risk management is interest rate risk management. Interest rate risk. Of course, we know the meaning of interest rate. Cost of borrowing or return on investment. We know the meaning of interest rates. If you are to define interest rates, you can define from two perspectives. Interest rates is the amount paid if a company borrows money. Hence, interest rate is the cost of borrowing. We can also define the interest rate as return on deposits, return on investments. If a company places investment, then you are going to expect a return on the amount you have invested. So from the perspective of the investor, interest rate is the return on my investment. There are two types of interest rates. The interest rate may be fixed or floating. Interest rates may be fixed or floating rates. We are used to fixed interest rates, where the borrower pays a fixed amount every year, maybe 10% of the amount borrowed, maybe 20% of the amount borrowed. The borrower pays interest a fixed amount yearly. We also have floating rates, floating interest rates. That is variable interest rates, whereby the interest rate the borrower pays is not fixed. The interest rate will vary according to the market interest rate. We call it floating rate. The interest rate will vary according to the prevailing market interest rate. Market interest rate is determined by the central bank, the monetary policy in a country. We know this. Now, what is the risk involved? Is there any risk involved if you borrow money? What is this interest rate risk we are trying to discuss? First, risk arises for businesses when they are uncertain about what is likely to happen in the future. Just 1 minute. For the break, let's continue with the class. Risk arises for businesses when they are uncertain about what is likely to happen in the future. In other words, all business decisions involve element of risk. All business decisions involve risk elements. If a company chooses to borrow money, if a company decides to borrow money to finance its business, there's element of risk associated with that decision. What is interest rate risk? Interest rate risk arises when businesses do not know how much interest they might have to pay on borrowings. Risk arises. Interest rate risk arises when businesses do not know how much interest they might have to pay on borrowing, where the borrowing is made at a floating rate loan. When a company borrows at floating rates, that means you are not certain the interest rates are going to pay in year 1 or year 2, because the rate will fluctuate, or the rates can the interest rate you paid in year 1 the interest rate payable in year 1 may be different from the interest rate payable in year 2, because the company has borrowed at a floating rate. That means the company is not certain. Please, can you mute Mr. Usman? When
Okay,
you join
sorry,
the
sir.
class, please help us mute. Thank you. Let's continue with the class. We talk of risk. That is, interest rate risk arises when businesses do not know how much interest they might have to pay on borrowings, where the company borrows at a floating rate. That creates risk. Or risk might arise. Interest rate risk might arise when a company is planning to borrow money. When a company is planning to borrow money at a future specified date, for example, today is 20th of April, and we had a management meeting. Our company had a management meeting. At that meeting, it was discussed and agreed that our company needs to borrow money. We need to borrow 500 million in 2 months' time. At the management meeting, you are represented as the finance manager. At that meeting, a discussion and a decision was reached that our company, we need to borrow money in 2 months' time. 2 months' time will take us to 20th of June. We are to borrow 500 million. Definitely, if you are going to borrow money, our company will pay interest on the amount borrowed. We are planning to borrow money in 2 months' time. The amount we want to borrow is very certain. We know the amount, 500 million. But the interest we are going to pay in 2 months' time on the actual borrowing date, the interest payable in 2 months' time on the actual borrowing date we are not sure. We are not certain what the interest rate will be for the business. What we call risk is uncertainty about what will happen in the future. Please give me more time. So there's uncertainty as to the amount of interest the company will pay. It is this uncertainty that we call risk. And that is what we try to manage. When you say manage uncertainty associated with the interest rate payable or the interest rate receivable, you are trying to manage the risk. Please note, the primary objective of interest rate risk management of interest rate risk management possible outcome of interest rates to meet the level of uncertainty, to limit the level of uncertainty for businesses so that company can plan with greater confidence and accuracy. Please, I want you to note that point very well. The objective of interest rate hedging is not to guarantee your business the best possible outcome, but to limit the level of uncertainty for your business so that as a business owner, you can plan your business with greater confidence and accuracy. Now we have done the introduction. What are the methods of interest rate risk management? What are the methods? What are the techniques? What are the techniques of managing your interest rate risk? Number one, smoothing. You can check page 164 for the material. I think page 164 of your study pack. You can check it. Number one method, you can use smoothing, that is smooth. How does this method work? Under this method, Under this method of managing interest rate risk, the loan or deposits are simply divided so that some will be at a fixed rate, some will be at a variable rate. When we say smoothing, you can divide your loan into two. The first part, you are going to take that loan on a fixed rate. The second part of the loan will be at a variable rate. If the interest rate should rise, if interest rate rises, only the variable rate loan will be affected. Only the loan at a variable rate will be affected. And this will have less impact than taking out the loan at a variable rate. That is the concept of smoothing. Let us illustrate briefly to further drive the explanation. Assuming you want to take a loan of 100 million, your company is planning to take a loan of 100 million. You can decide to divide it into two. The 100 million loan, divide into two. 50 million will be at a fixed interest rate. 50 million, the balance of 50 million will be at a variable interest rate. You are trying to smooth. If interest rates should rise, only the 50 million, only the variable rate loan will be affected. Your fixed rate loan will not be affected. If interest should fall, then you are going to pay less on your variable rate loan. That is the concept of smoothing. Number two, pooling of assets and liability. Pooling assets and liability together. How does this work? Pooling assets and liabilities. Some of the interest rate risk to which a firm is exposed may cancel out each other. Some of the interest rate risk to which a firm is exposed may cancel out each other. By pulling together assets and liability which have the same exposure to interest rate changes, by pulling together assets and liability, which have the same exposure to interest rate changes. Let us illustrate briefly how to pull asset and liability together. You may be asked to explain this in your exam. Let us illustrate this briefly. Your company is planning to borrow money. The company XYZ PSC. We plan to borrow 100 million naira. We are planning to take a loan of 100 million naira. This loan is a liability. We can decide to take this loan at a variable rate, variable interest rate. When you now take the loan, you are going to use it for your business. You can deliberately create an investment. Place investments of 100 million naira. Also at a variable rate, variable interest rate. Please let me clarify this. When you borrow money, that money, you are not using that money for investment. You are using that money for your business. But please remember, the fact that a company is borrowing money does not mean the company does not have cash. Dangote borrows money. It doesn't mean Dangote does not have his own cash. Please, I want to understand this very well. The fact that a company goes to borrow money does not mean that company does not have sufficient cash. So when you borrow money at a variable rate, you are going to use the loan for your business. Now use your personal cash. Go and place investments at a variable rate. Both the loan and the investments, both the liability and the assets are exposed to the same interest rate changes. If interest rate rises, you are going to pay higher interest here. At the same time, you are going to receive higher interest here. As you are paying interest on your loan, you are receiving interest on your investment. The interest received can be used to cancel out the interest paid on your loan, because both assets and liability, both the asset and liability are exposed to the same interest rate changes. This is what we call pulling assets and liabilities together. Any question, please? We have to round up this class next week. If you look at the number, people are not joining the class again. All right, if there's no question.
Yeah.
Is anybody speaking?
No, I'm saying that we are here. Don't be discouraged.
Ah, you speak for yourself. Oh. No, we are still going to, of course, we are still going to, the class will close officially this weekend, sir. Method number 3.
Now, all those past
Forward.
questions, especially the recent past questions, not done it though.
Which one is that one? Oh?
November 2025.
What do you want to do there?
Like, I thought they used to maybe do solve the questions and tell us how to answer it. Yeah. I'm just
You can pick the question and attempts now. The answer is there now.
okay.
Are you want me to solve it for you? Will I can repeat the same question this diet?
Oh, it's true.
That question you can use it for practice.
All right.
The answer is already there for you. Method number 3. Forward rate agreement, in brackets, France. Please, the first two methods, no calculation. Subsequent method, there is calculation. Forward rate agreement. This is a binding agreement between two parties. A binding contract in which two parties agree on the interest rate to be paid or the interest rate to be received on a notional amount at a specified future date. The forward rate agreement. A binding contract in which two parties agree on the interest rate to be paid or the interest rate to be received on a notional amount of principal at a specified future date. This instrument allows the borrower or the lender. This instrument allows the borrower or the lender to fix an interest rate which applies over a specified future period. The instrument is used by the borrower or by the lender to fix interest rates over specified future period. Please note, these instruments cannot be used to borrow money. The instrument is not used to borrow money. We only use the instruments to fix interest rates. Please note that point. Forward rate agreement is an instrument that is used to fix interest rates. It is not used to borrow money. Please get it clear. We only use the instrument to fix your borrowing rates. Please note the following point. Please note the following point. A potential borrower buys FRA. The potential borrower buys forward rate agreement. Why the potential lender says forward rate agreement? Please note the points. If your company is planning to borrow money, then the potential borrower will buy FRA. If your company is planning to place investment, then the company becomes lender. The potential lender says FRA. The FRA rates are quoted from the viewpoint of the bank. The forward rate agreements are quoted to favor the bank. The bank buys at a low rate and sells at high rates. The bank buys at a low rate and sells at an higher rate. So please notice, when the bank is buying FRA, bank will buy at a low rate. When the bank is selling FRA, bank will sell at an higher rate. Lastly, FRAs are variously described. Forward rate agreements are variously described. The forward rate agreements are variously described. You can have 3 to 9, 3 times 9, 3 versus 9. It means the same thing. You can have 3 to 9, 3 times 9, 3 versus 9. The first figure denotes the commencement period. The commencement period of the hedging. The second figure denotes the end of the period. The difference between the two figures. The difference between two figures indicates the length of borrowing or lending. Let us illustrate this. If examiner says 3 to 9, what the examiner is telling you is that this means in 3 months' time, we plan to borrow for 6 months. In 3 months' time, our company is planning to borrow for 6 months. Look at the 6. 9 minus 3. That will give you 6. So the first figure is saying that in 3 months' time, my company will borrow money for 6 month period. If examiner do like this, 2 to 5, it means in 2 months' time, we plan to borrow for 3 months. Difference between 5 and 2. This will give me 6. This will give me 3. So please in exam, examiner will give you different description. You must know the appropriate one to pick. Assuming the examiner says, in 3 months' time, our company is planning to borrow for 4 months. In 3 months' time, our company is planning to borrow for 4 months. That becomes 3 to 7. So please understand that. Then also, we said the FRA rate is binding. We said the FRA rate is a binding rate. Let us also illustrate that. Assuming in 3 months' time, you are planning to borrow money in 3 months' time. You now approach your bank today. You approach a bank today that, please, I want to borrow money in 3 months' time. I want to go into FRA. I want to go into forward rate agreement. I want to obtain an interest rate for the money I'm going to borrow in 3 months' time. You want to obtain interest rate today. Interest rate today, assuming the interest rate is the FRA rate agreed. You agree a FRA rate of 15%. You have entered into agreements. You agree a FRA rate of 15%. Today, you now wait until 3 months. You wait until 3 months. 3 months will take us to April, May, June. That is like July. When you now get to 3 months, on the actual borrowing day, today you agree a FRA, 28th April. You now get to 20th July. You now want to borrow your money. You now approach the bank to borrow money. Please note, you can approach any bank to borrow your money. You can go to First Bank to do FRA rates, to enter into forward rate agreement. You can approach First Bank today to enter into forward rate agreement. It is not compulsory you must go to First Bank to borrow your money. Forward rate agreement with First Bank that any day I'm going to borrow my money, the interest rate I'm going to pay is 15%. Now, on 20th July, you now want to borrow money. You now approach Zenith Bank. Zenith Bank is not aware that you have hedged. You are with First Bank. Forward rate agreement, 15. You now approach Zenith Bank to money. On getting to Zenith Bank on 20th July, Zenith said, we are going to give you this loan at 12%. We can give you this loan at 12%. If you take loan at 12%, and you have agreed 15% with First Bank, after you pay 12% to Zenith Bank for borrowing, you are going to pay 3% to First Bank to complete 15% you have agreed. In that case, you are going to pay 3% compensation to First Bank to complete 15%. Alternatively, you borrow this money from Zenith at 18%. Remember, you have agreed a FRA rate of 15%. If you pay 8% to Zenith Bank, that means you have paid more than 15%. First Bank, we have to compensate you with 3% interest rate so as to reduce the amount to pay to 15%. Interest rate futures are financial derivative products. This is a financial derivative, in bracket, futures contracts. This is a financial derivative product, a futures contract with interest rates bearing instruments as an underlying asset. The underlying asset is your interest rates bearing instruments. Futures use the inverse relationship. Use the inverse relationship between interest rates and bond prices to hedge against interest rate risk. Futures use the inverse opposite relationship between interest rates and bond prices to hedge. When interest rate rises, value of futures will fall. When interest rate falls, value of futures will rise. Please always remember, when interest rate rises, value of futures fall. When interest rate falls, value of futures rise.
I bet. Eléyìí tó gba 194 tó ń béèrè pé tí wọ́n máa ra admission last week. 195 going last week.
No, please help us mute. Thank you, sir. We can use this opposite relationship between interest rates and future a potential borrower sells futures today. Please listen to that. Potential borrower sell futures. If interest rate rises, value of futures fall. A potential borrower will sell futures at the commencement of the hedging. If interest rate rises, value of future will fall. The borrower can buy futures back at a low price, thereby making profits. A potential lender buys futures. The following points should be noted. Potential borrower sell futures, while potential lender buys futures. Interest rate futures are legally binding. Hedging with futures involve two separate markets, two separate transactions. Hedging with futures involve two separate transactions. We have the money market, that is the cash market. The money market is the market where you can borrow your money or you can place investment. Your money market, your cash market, is the market where you borrow or lend. You now have the hedging market, market where you can hedge. That is the futures market. At the futures market, you don't borrow money. You only hedge your interest rates. At the futures market, you don't borrow money. What you do is that you hedge the interest rate component against fluctuation. For you to understand it better, look at the insurance company. If you want to buy a car today, if you want to buy a car, you approach the auto company. You can approach Honda Place Motor. You can approach Toyota, Elizabeth Plaza. If you are buying a car today, we approach the auto company. If you want to insure your car, you now approach the insurance company. The same thing happens here. If you want to borrow money, you approach the commercial bank to borrow money. If you want to hedge the interest rate from fluctuation, you approach the futures market. The futures market is an hedging market. So please bear in mind, when we get to calculation, you are going to be seeing two different markets. The futures market transaction is designed to be in the opposite direction of the money market transaction. All short-term futures are based on borrowing or lending for 3-month period. Please note, futures contracts are for 3 months. 3 months. You can have March contracts, June contracts, September contracts, and December contracts. The contracts are for three months. Also, please note, futures prices are quoted in the index form. Futures prices are quoted in the index form. And profit or loss on futures are measured in ticks. When we get to calculation, some of these things we demonstrated. Now, what are the steps? Steps require, if you are to hedge, you have like 5 steps. Determine the target interest amount, your target interest outcome, based on the desired interest rate. Determine the number of contracts required. Number of contracts is calculated as amount of actual load, amount you plan to book, divided by your contract size, multiplied by length of borrowing, divided by 3. The 3 represent 3 months. Step number 3, determine whether to buy or sell futures. Don't forget, borrower sell futures, lender buy futures. Step 4, determine the contract expiring dates to use. Then your final step. Evaluate your hedge. To evaluate the hedge, you might need to estimate the closing futures price. If you are not giving, you might need to estimate your closing futures price. And you are going to use basis. Yes, Madam Tosi.
Good evening, sir. So what did you say the fourth step was?
The third or fourth?
Fourth. After determining whether to buy or sell futures.
Number 4, determine the contract expiring date to use.
Okay. Thank you.
You're welcome. Let's continue. When you get to your final step, depending on how the question is given to you, some question examiner will give you the closing futures price. Some examiner will not give you. In that case, you need to go through basis. Your basis is calculated as spot price minus futures price. Your spot price is the current interest rate. The current interest rates are the money market. That is your spot price. Interest rate at the money market. Your futures price is the rate at the futures market. So you might need to use your basis to derive your futures price. Futures price at commencement, futures price at close. This is better demonstrated with questions. Interest rate guarantees. Number 5 method. Interest rate guarantees are short-term interest rate options with a maximum guarantee of 1 year. Interest rate guarantees are short-term interest rate options with a maximum guarantee of 1 year. That is 12 months. The option guarantees that the interest rates, the option guarantees that interest rates will not rise above a certain level. The option guarantee is used to fix maximum borrowing rates, maximum borrowing interest rates. The option guarantee is used to fix maximum borrowing rate. Or you can also use it to fix minimum lending rates. But remember, it's an option. The guarantees are options, not obligations. The guarantees are options, not obligations. Your interest rate guarantees can be used to protect yourself against adverse fluctuation in interest rates. You can use your guarantees to protect against downside risk. This method is similar to forward rate agreements, but there are major differences. Interest rate guarantees. Interest rate guarantees are similar to forward rate agreements, but they have major differences. Interest rate guarantees involve payment of premium to the seller of the guarantees. But there is no premium payable with France. Forward rate agreements do not involve payment of premium. Secondly, interest rate guarantees can be used to protect against downside risk. For example, if interest rates rise, you can apply your guarantee. At the same time, interest rate guarantees allows the company to take advantage of favorable movement in interest rates. It allows the company to take advantage of favorable movement in interest rates. This is not possible with France. With forward rate agreements, you can't take advantage of favorable movement in interest rates. And please note, premium payable is a flat charge. It's not time prorated. Let us illustrate briefly. How interest rate guarantees work. Interest rate guarantees for The guarantees can be used to fix your rate. Assuming we fix a rate at a guarantee rate of 10%. Our company is planning to borrow money in 6 months' time. We now go into interest rate guarantees that the maximum interest rate we are going to pay is 10%. On the actual borrowing day, you now get to your bank. On the actual borrowing date, bank now give you interest of 15%. And you have entered into a guarantee of 10. In this case, you are going to apply your guarantee. You are going to borrow at 10%. You are going to exercise your guarantee. You are going to borrow at a maximum guarantee rate of 10%. But if the interest rate happens to be 7%, when you want to borrow your money, and you have entered into a guarantee rate of 10% maximum, their guarantees are options. In this case, you are going to opt out of the option contract. You are not going to apply your guarantee. You can now borrow at the prevailing rate of 7%. Unlike FRA, you can take advantage of lower interest rate at the market. Borrow at 7%. But you are going to pay premium. For you to obtain the guarantee, a premium must be paid. All right, let me take one more. By 10 o'clock, let's solve one question. Method number 6. Options of futures. Options on futures are options to buy or sell futures on interest rates. Hence, all the peculiar characteristics of futures contracts are valid. Options on futures. These are options to buy or sell futures on interest rates. You are taking an option to buy futures interest rates, or to sell futures interest rates. Hence, all the unique characteristics of futures contract are still valid. What are these characteristics? The contract are standardized in size. You can have one contract, two contracts. You cannot have 5.5, no fraction. All the contracts are for 3 months. A call option gives the holder the right to buy futures. A call option gives the holder the right to buy futures. A put option gives the holder the right to sell futures. Please note this. Potential borrower sell futures in the futures market. A potential borrower sell futures in the futures market or buy put option in the option market. We are combining two products, option on futures. The potential borrower can sell futures in the futures market or can buy options in the option market. A potential lender buys futures in the futures market or buy call option in the option market. By buying call option, the call option will give you a right to buy futures. The potential lender will buy call option. That call option will give you the right to buy futures contract. Potential borrower buy put options. The put option will give you the right to sell. When setting up your hedge, you may be given a number of exercise prices. When setting up the option hedging, it is possible that the examiner will give you more than one exercise prices. This is unique to option on future. You must determine the appropriate exercise price to select. You must determine the appropriate exercise price to select. All right. Just one more to round up. Let me just round it up. Number 7 method. Interest rate swap. Mr. Moses, please can you mute? Interest rate swap is an agreement between two counterparties. Interest rate swap is an exchange between two counterparties of interest rate obligation. Agreement between two counterparties of interest rate obligation. An exchange of interest rate obligations between two parties on the same currency, on the same amount of notional principal. Interest rate swap agreements between two counterparties to exchange interest rate obligation on the same currency, on an agreed amount of principal, for agreed period of time. Let us illustrate briefly. Company A, so that we can just round up this. Let's illustrate this briefly. We have company A. Company A. Company A plan to borrow 500 million at a fixed rate. Company B also plan to borrow 500 million at a floating rate. The two companies, they don't even know themselves. But two of them has approached the same bank. Company A approached First Bank. Company B approached First Bank. Now want to borrow money. And you happen to be the manager. The two companies approach you. You can bring the two companies together under interest rate swap. You can bring the two companies together under interest rate swap. If company A borrow at fees, company B borrow at floating, two of them can agree to exchange interest rate obligation. Company A will transfer fixed rates to company B. Company B will transfer fixed rate to company A. They will now go into interest rate swapping. But please note, they will only arrange swapping. Interest rate swap will only be arranged if the swapping will reduce the overall cost of borrowing for the two companies. Interest rate swap will only be agreed if there's mutual benefit, to be derived by the two companies. Each company will borrow at a rate where it has comparative advantage. Each company will borrow at the interest rate where you have comparative advantage. This comparative advantage will reduce the overall cost of borrowing for the two companies. Right, I think we can stop here. Any other thing can be discussed. We can stop. So this is your exam. We are not certain as to what the examiner will text. This uncertainty creates risk for us. And we need to manage the risk. All right, any question, any clarification? We have just like 30 minutes or just like 45 minutes to round up the class. All right. Let's talk question one. If time permits, I hope I can finish it, but I'm not sure. Please check your study pack, page 164, question number 1. Check your study pack, page 164, question 1. Let's run through the question. All right, I'll read quickly. Katangwa Limited. We need to borrow 50 million naira in 3 months' time for a period of 6 months. The company is concerned that interest rates are expected to rise over the next few months. Interest rate and forward rate agreement are currently quoted as follows. You have the spots. You have 3 to 6 francs. You have 3 to 9 francs. Requirements A. Explain how a forward rate agreement may be useful to the company. Illustrate this on the basis that interest rate rise to 6.5 or 4 to 4.5. Let us try to even explain the question. Our company, Katangwa Limited, we need to borrow 50 million naira in 3 months' time for a period of 6 months. That means in 3 months' time, we are going to borrow for 6 months. So if I want to use forward rate agreement, I'm going to use 3 to 9. I'm going to use 3 to 9. I will use 3 to 9 francs. In 3 months' time, our company will borrow for 6 months. So I should use 3 to 9 francs. So if you are I'm not explain how a forward rate agreement can be useful to this company. Is to borrow. That means the borrower buys francs. Borrower will buy francs. Now look here, please. Katangwa we need to buy forward rate agreement, 3 to 9 forward rate agreement. That means the bank will sell. If Katangwa is buying, bank will sell. High rates. Bank sells at higher rates. That means the franc rate will be 5.94. This one is higher. So if you have to explain this, the company will need to buy a 3 to 9 franc forward rate agreement. The appropriate interest rate will be 5.94% franc rate. This rate is binding. This rate is binding on the future borrowing. This franc rate may result in compensation paid or compensation received if actual interest rate is higher or lower than the franc rate. The forward rate agreement may lead to compensation paid or compensation received if the actual interest rate is lower or higher than the franc rate. This can be illustrated below. Look at the explanation. Entry into a FRA, that is forward rate agreement. They allow the company to effectively lock in an exchange rate. That means when we say lock in, fix. Lock in means fix an exchange rate by entry into forward rate agreement. This allows the company to effectively lock in an exchange rate for a future specified period. In this case, for 6 months period, starting in 3 months' time, ending in 9 months' time. That is, we should use 3 to 9 FRA, which should lock the company into borrowing rate of 5.94%. This will lock the company into a fixed borrowing rate of 9.4%. The FRA rate is independent of the loan. The forward rate agreement is independent of the loan itself, upon which the prevailing interest rate must be paid. The prevailing rate, the borrower will pay the prevailing interest rate on the loan. However, any differences between the actual interest rates and the FRA rate will result in cash flow from the FRA to offset the higher or the lower interest rate. Please carefully study this. So much energy is put into online class. Please carefully study this. Now let's illustrate with figures. Examiner says, assuming on the actual borrowing date, interest rate happens to be 6.5 or 4.5. You can treat like this. Your FRA rate, what you agree to pay with the FRA is 5.94%. Whether scenario 1 or scenario 2, your actual borrowing rates because of space. Actual borrowing rates for scenario 1, 6.5%. Scenario 2, 4.5%. The difference is the compensation. We have compensation paid. Compensation paid or received. Now look at it, please. If the company borrows at 6.5, that means you have borrowed, you pay more than what you should have paid. You should have borrowed at 5.94. So if the company borrows at 6.5, then the company will receive compensation. Difference between 9.54 minus 6.5. we have a difference of 0.5. That means FRA will pay compensation to Katangwa to compensate Katangwa. The difference here, Katangwa has borrowed at 4.5. That is less. 5.94 minus 4.5. Difference of 1.44. Katangwa will need to pay compensation to the FRA. Now convert this to figures. Actual borrowing cost. Actual borrowing cost at 6%, 6.5%. Scenario 1, actual borrowing cost, actual borrowing cost, 6.5% of 50 million naira for 6 months. What is the actual borrowing cost? Please try to calculate. Yeah, actual borrowing cost 1,625,000. We have overpaid. Then compensation received. Compensation received. We have overpaid by 0.56%. That becomes 0.56% multiplied by 50 million for 6 months. Please work out.
I think 14,000. I wish 14 million.
Kilo day.
Or 1.4.
140,000.
Okay.
The answer is 140. So if I return here, actual borrowing cost 1,625,000. That is the cost we are going to pay here. Now compensation received now because we have overpaid. We are going to receive 140 compensation. Actual borrowing cost. Examiner say 4.5% for 50 million for 6 months. What is the actual interest paid? Actual interest paid, yeah. Actual borrowing cost. 1 million.
125,000.
1 million. 125,000. 1 million. 125,000. 1 million. 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 We have underpay here because the franc rate is 5.94. Compensation return to the franc. Compensation. Page 1.44% of 50 million for 6 months. Please work that out.
$360,000.
Thank you. Now return here. Actual borrowing cost 1,125,000. Compensation paid now. Additional, because we have underpaid, 360 will now be paid back to franc. Now get your net interest cost. Let me take this one away. Let me put this one here. Paid all receipts. Our net interest cost negative 1,625,000 plus 140. This will give us 1,485,000. That is the net interest cost there. Here you also have 1,485,000. This is your net interest cost. It must be the same. If you want to take it back to percentage, effective loan rate. What is the loan rate? Effective loan rate. Please look how to calculate it. Your effective loan rate effective loan rate is calculated as net interest cost over amounts borrowed multiplied by 12. 12 represents 12 months divided by length of borrowing. Please keep this somewhere. So if I want to calculate the effective loan rate, wow, is it network? So many students have left the class. Maybe it's due to network. Initially, we started with 15. Now you have only 8 students in class. So if I want to get effective loan rate, my net interest cost, 1,485,000. Amounts borrowed, 50 million. Multiplied by 12. Length of borrowing, 6 months. Please work this out. You are going to get 5.94%. The answer you get multiplied by 100. Convert it to percentage. Effective loan rates. If you look at it, that go back to the FRA rate. That FRA rate is binding. Compare the use of interest rate futures with forward rate agreements in this instance. Format. Let us compare interest rate futures have the same effects as forward rate agreements. In effect, locking into an interest rate. If we lock the company into an interest rate, however, unlike forward rate agreement, however, unlike FRAs, interest rate futures are standardized in terms of size, duration, and term. And they are tradable on exchange. Interest rate futures, unlike forward rate agreement, are standardized in terms of the size, the duration, and the term. And they are tradable on exchange. They are generally closed out prior to maturity with any gain or loss offsetting any higher or lower interest cost when borrowing. The gain can be used to reduce your high interest cost. The standardization in terms of size, duration, and term may appear to make them limited compared to FRAs. However, the ability to trade futures contracts, the ability to trade them means that any hedge can be easily released at any time if conditions change. What that is trying to explain is that although interest rate futures are standardized, but you can still trade them. You can remove the hedge. You can sell them or buy them if circumstances change. Since we are planning to borrow money, Since the company is planning to borrow money, then the borrower will be concerned with interest rate rising. The borrower will be concerned with interest rate rising. In that case, we shall look for profits on options, on futures. The borrower is worried about interest rate rising. In that case, the company will sell futures. A potential borrower sell futures. If interest rate rises, value of futures will fall. The company can buy back futures at a reduced price, thereby making profits. These profits can be used to reduce higher interest costs. So what we are saying is, if the company wants to use interest rate futures, in that case, the company will buy futures. But the company will sell futures. If the company wants to borrow money, Katangwa will need to sell futures. If he's using Katangwa value of futures will fall. Then Katangwa at a reduced price, thereby making profits on futures. This profit will be used to reduce the increase in interest cost. Oh. Requirement C. Explain how interest rate guarantees or short-term interest rate caps could be used. Interest rate guarantees or short-term interest rate caps offer the opportunity to limit the impact. Offer the opportunity to limit the impact of any adverse movement in interest rates, while at the same time benefiting from any favorable interest rate movement. You can limit adverse changes in interest rates. At the same time, you can take advantage of favorable movement in interest rates. Interest rate guarantees are in at an agreed interest rate at a full. This means that interest rate rises, the option will be exercised. If interest rates should rise, you are going to exercise your rights to borrow at a reduced rate. If interest rate falls, you are going to opt out of the option contract.